Welcome back, traders and investors. We have Chris Whalen on the line. Chris is Senior Managing Director of Headed Research at Kroll Bond Rating. He's responsible for financial institutions and their corporate ratings. Now, that sounds like a really tough job to me, Chris.
Well, it's a lot of fun actually. We are about 4 years old. Kroll Bond Rating Agency was started by Jules Kroll, the world famous investigator after the financial crisis, and we're profitable and growing. We have about half the business is where we started really, which was commercial, residential, asset-backed securities, all sort of exotics as well. We're very well known in that space. And more recently, we've been growing in areas like financial institutions, which I'm responsible for, and public finance. And the great story is that there's a lot going on, even in banks. You'd probably be surprised to hear that, but we've been rating an awful lot of regional and small banks who are all quite busy. They're lending money and they're raising money and buying one another and everything else. And, it's quite encouraging. So it's a great time to be in the ratings business.
And you spent some time at Bear Stearns and Company.
Yes, I did. I worked for the Bear twice. It's possible to make the same mistake 2 times, but I loved the Bear. The Bear was great. I worked for them in London in the 80s, and then later on I worked in the investment bank for Alan Schwartz and M&A.
So you there near the end, or were you gone?
No. By then I was gone. I had gone to work for Prudential after Bear, and was focused on technology investment banking, and then had my own firm for about 10 years, Institutional Risk Analytics, which was a bank ratings and analytics firm, which I sold last year. I spent a little time in the mortgage industry. I most recently was at a special servicer called Carrington, and then I came to Kroll about 3 months ago.
Chris, talk about the process in rating bonds. Like, how do you go about it?
Well, what we are here to do essentially is protect investors. What we're trying to do is tell them what is the risk of default in a debt security. So, for example, when we rate banks, we start off by rating the bank unit, both a long-term unsecured, long-term subordinated, and a short-term rating for the bank. And then we rate the parent holding company, same thing, long-term unsecured, long-term subordinated, and a short-term kind of money market rating, if you will. The parent holding company tends to be one notch lower in rating than the bank. And the reason for this is that the bank, because of federal deposit insurance, because of other factors, is perceived to be a better credit. We think it's a better credit. And in fact, in our ratings, you'll see when we talk about systemic risk and the possibility of systemic support, we still believe that the government, in fact, is going to support the liabilities of the subsidiary bank, large or small, whereas with the bank holding company, not so much. It's pretty clear to us that the bondholders, the equity holders of the bank holding companies are at risk. So even though we don't necessarily adjust the rating in favor of the bank versus the parent company, for example, if a bank fails, even a little bank, FDIC will pay out all the brokered deposits, large and small, even if they're not technically insured. And the reason they do this is because if they started shooting brokered deposits and imposing losses on them, they believe they would cause systemic panic. Jeffrey Lacker, one of the Fed presidents, spoke about this in his testimony before Congress last year, and we actually refer to his statements in our footnote in that part of our ratings report. So ultimately, what we're trying to tell you as the investor, whether it's a bank or a non-bank, is what is the likelihood that this piece of paper is going to be money good or not? That's what it comes down to.
Do you look at any of the European banks at all? Probably not, but do you have any feeling for those? Because we've been looking at this. Oh, do you? Because we've been looking at Deutsche Bank. We've been talking about it on the show, and the stocks went from $50 to $34. And we've been looking at some of these other European banks, and obviously there was some issues there back in 2011. Do you think there's any issues materializing here again with some of these European banks?
Well, the issues, we rate about 100 foreign banks all over the world. We have a platform called SRS, which was the old Lace Bond Ratings business, which we acquired a few years ago. And what we do is, we take their financials and we come up with a fairly conservative financial condition rating, I would call it. It's not necessarily used as a bond rating by investors, but it gives you a sense for the condition of the bank. All the European banks for a while now have had a systemic problem with capital. And the reasons for this are numerous, but they really just don't have as much capital as their U.S. counterparts. Deutsche Bank, for example, if you really look at their assets on a simple leverage basis, has about half the capital of a J.P. Morgan.
Right.
They take a lot of risk. They bought Bankers Trust years ago. A lot of their business is really not banking anymore. It's derivatives and securities. So I think on the negative side, if you will, it's an institution that needs more capital. They have raised a little bit of money this year, but I still don't think it puts them anywhere near the top 4, top 5 banks in the U.S. in terms of leverage. The way they get away with this is what they call risk-based assets. This is the game that's played with the Basel III process, where they play around with the different types of assets they have, and they have different capital weightings. So they basically reduce their total assets by about a third, so they look a little better. But the reason U.S. banks got through the crisis so well is because of the simple leverage ratio, which is just assets versus capital without any weighting. And that's why our banks tend to be better capitalized. That's why Sheila Bair and all of my friends at the FDIC fought so hard to keep the leverage ratio test and not go down the road to Basel III, which I think is ridiculous. The U.S. should withdraw from Basel. And it's interesting, Mr. Tarullo at the Fed has been saying pretty much the same thing. He's actually suggested explicitly that U.S. regulators abandon the risk weighting process in Basel III because it makes no sense to anybody. It's really not a useful tool. But, the positive in Europe is that most of these banks, Deutsche, the French banks, the Italian banks, are de facto national champions. No one can imagine Deutsche Bank failing because the German government would bail them out.
Right.
With some of the smaller German banks, Commerzbank particularly, they've been through the meat grinder, and it's unclear to me what's going to happen with them. Simply again because they don't have enough capital, and it's hard to convince investors to put capital in there because they're so good at losing it. German risk management is not as good as one might suppose, and even though unfortunately Germany as a society does not really have a lot of active debate on a lot of these issues. The politicians control the banks. They sit on the advisory boards of the big institutions. So you don't really have an open, frank discussion of what's going on inside these banks. And that's, it was inside the banks that you had the problems. In Europe, they didn't have a housing boom. You didn't have consumers going out and getting 100 LTV mortgages. Most of the problems were caused in Europe by the investment choices of the large banks, by them buying toxic waste that was either manufactured in London or the U.S., and just making bad asset allocation decisions. It wasn't because consumers were engaged in a housing boom, as you saw, for example, in Spain or Ireland. You didn't see that in Germany. You didn't see that in France.
We have Chris Whalen on the line, Senior Managing Director of Headed Research at Kroll Bond Rating. So when you're talking about bonds and you're rating these companies, obviously a lot of it is tied, to interest rates. And the Fed made a clear statement that they're going to continuing the taper, perhaps accelerate the taper and end it maybe in October. Rates have been low for so long. Inflation seems to be steady. Obviously, with the bond ratings being affected by interest rates, what's your short-term and longer-term outlook for interest rates here?
Well, we did a piece on the bank ratings or bank earnings for the second quarter, and I had a part of that piece. I talked about the Bernanke shoku, which is a Japanese word. It means the Bernanke shock. And this was about a year ago, the end of June last year, when Chairman Bernanke decided to have a press conference to start to talk about a change in policy. And I think he honestly wanted to be forthright and transparent. The problem is the markets weren't prepared. Rates moved dramatically, both the 10-year Treasury note and more particularly the TBA market, which is where people hedge mortgage exposure. And a number of financial institutions took some rather big losses. Now, since then, you've had a lot of volatility one way or another. The street, the economists particularly, have been predicting higher interest rates because they take the guidance from the Fed at face value. But the thing that concerns me is that you don't really have strong demand for credit. And I think this has been illustrated by the fact that if you look at the institutional market, the appetite for assets has driven rates back down. We had the 10-year go through 2.5%. It's still around those levels now. So between the end of last year, when the Fed announced that they were going to taper their purchases, and everybody thought, well, they're going to be buying less paper, rates have to go up, right? That was kind of the conclusion. But I think the conclusion was wrong because there is so much liquidity out there, especially in the institutional market where we work. It's hard to imagine rates going up. In fact, if anything, you're seeing the acceptable returns that investors are willing to take go down. You know, in all different asset classes too. It's not just in treasuries and bonds, it's across the board. So I think that it's going to be very hard as a practical matter for the Fed to get rates to rise, even if they want them to, because the market is telling them that, hey, we got way too many pieces of paper with presidents on them chasing returns. And that to me is the problem. It is in a way inflation because it's forcing investors to accept returns that are probably negative in real terms if you really assess the inflation environment. And it also is causing people to do silly things. You know, I'll give you a great example in the mortgage sector where I spend a lot of my time. There was recently an auction for distressed assets, and it went to a firm other than Auckland. And Auckland and their affiliate Altisource got sold off very heavily in the equity market because people said, oh, well, they didn't get these assets. They lost the auction. And there have been a lot of other auctions where established players have not won, and some new players who've come in recently with new money won. But at returns that are half of where they were a year ago. And you have to ask yourself a question. Was it a bad thing to lose the auction? I think no. I think it was actually a good thing for them to lose the auction in this case because investors are out there irrationally chasing, say, mortgage securities, mortgage servicing rights, non-performing loans that used to have returns in the high teens. Now those returns are in single digits. I think that what the market is telling us is that there's way too much money chasing too few opportunities, and that is inflation.
Right, and you're seeing that going on in the market. Question here coming out of the chat room here. Is there an emerging market banking system that keeps you up at night, like Brazil or China? I mean, what's your assessment of those countries?
Well, I think China probably first and foremost because they always imitate us. I actually read Chinese history as an undergrad at Villanova. We had some really awesome teachers in those days. And, you know, the Chinese have always been emulating the West, trying to generate growth, and they use leverage probably more than we do. This is what people don't understand. They have banks, they have government-sponsored entities that create credit and disperse it in order to generate short-term demand, and then they don't pay the loans back. So the bad asset problem in China is rather profound. The question of transparency, everything else with Chinese banks is, I think, extremely important. But the Western investor community wants to believe what they want to believe. And so they tend not to react because they believe the Chinese government, their big reserve position, will ultimately back the banks in that country. So that's, you know, you could say that about a lot of emerging markets, by the way, but I think China is probably the most worrisome simply because foreign investors are not tempering their judgment with respect to economic and financial statistics adequately. On the other hand, the part that makes me very happy when I look at banking is small banks in the United States. It's the only sector there where there's anything really going on. If you go on our website and look at some of the ratings we published in the last couple of months, really since I've been here, we've done more than half a dozen different small regional and community banks, a lot of them in Texas. And these guys are raising money and making loans and expanding credit in a way that the big banks can't.
Chris, do you got a couple examples? Do you got a couple specific examples?
Oh, sure. Cadence, which is Alabama, Texas-based energy lender. Paul Murphy, the former head of Amegy Bank, is the CEO. Very smart guy. Not consumer-focused. They're doing C&I lending in energy and restaurants, interestingly enough. Another very interesting story is a bank out in California called Bridge. Bridge is focused on the tech sector, both in California and the Northeast. Very much a B2B kind of C&I focus. Same thing, no consumer lending. Another one, Texas Bank, Next Bank, down in Dallas. The founder of Whalen Capital, a couple other very large investors in that community, capitalize that bank again, B2B.
Do you have some symbols on these, Chris? Do you have some symbols on these?
I can't remember the symbols, but they're easy to look up. Just go on Yahoo Finance. Another interesting one is Customers Bank in Pennsylvania, Jay Sidu, the former head of Sovereign Bank. Again, a very particular focus. He's both business and consumer. He's banking high net worth families in the Northeast, especially those who like to invest in multifamily real estate. Model has no fees. Very lean in terms of branches. He's trying to keep his efficiency ratio down in the 50s or even lower. So, I think what's exciting for me is that there are a lot of good things happening in the banking sector, but unfortunately, most of the larger institutional investors won't go there because they'll only look at the top, 6, 8 names for liquidity reasons. Even you get to U.S. Bank, which is a large institution, best performer in the country in the top 5, and it's still considered too small. It's also locked up, very loyal shareholder base. They're not going to sell. They don't keep their shares in margin accounts, so you can't borrow the stock. But I tell you, for investors who can tolerate a little liquidity risk and who are patient, small banks is where it's happening, and the non-bank sector too. The non-bank mortgage sector, specialty finance, even consumer finance based on non-bank models, that's all going to come back because those sectors were rolled up by the commercial banks and largely destroyed. Things like household finance. We need to rebuild that whole business. So I think it's quite exciting. There's going to be a lot of opportunities to deploy capital in those sectors in the next few years.
Chris, one more question before we let you go, just from the chat here. We got a lot of Canadian listeners there, and some of them probably want to know about the Canadian banks. Do you have any thoughts on the big Canadian banks there? I think there's about the big 6. Any thoughts?
Well, Canadian banks, by and large, are big and boring. I mean, they don't take a lot of risk. They don't have securities arms. In Canada, the large banks are also the asset managers. You don't have big independent mutual funds in Canada, so that tends to come out of the trust departments of these banks. And you have leaders like Toronto Dominion, for example, which is it's a well-run institution. It doesn't have the capital markets or derivatives risk that a big universal bank in, say, New York or London has, going back to Deutsche Bank, right? But the Canadian banks are pretty solid. I like them as a group. I mean, some of them have had bad experiences in terms of their forays into the U.S. market and some of the investments they've made here, and all foreign banks have, by the way. I can't think of a foreign bank that's been successful trying to enter the U.S. market. It's just been, 20, 25 years. But I think Canadian banks overall are very solid.
Okay, we've had Chris Whalen here. He's Senior Managing Director and Head of Research at Kroll Bond Rating, giving his outlook on the on interest rates and also the banking sector, kind of favoring smaller banks. Tim Melvin would probably agree with you. He's of the Deep Value Investor Letter, has been looking at some of these banks. And, if you could get over the liquidity issues, you're right, could be some good investments in that sector. Well, Chris, thanks for coming on. Have a good trading day and a good weekend, and we'll talk to you soon.
Yep, same to you guys. Thank you.
Okay.